Good morning, traders. Welcome to the Flow Show, CPI Day, Thursday, 10th of October. Big data. Pretty much been waiting for this the whole week. So I hope it gives us something to get our teeth stuck into. Or it might be a bit of a quiet end to the week. But, fingers crossed, eh? Before we start, just want to highlight what's on the screen there. Our trader funding program. Still running a 20% off any assessment in October. So purchase that in October, get that 20% off. Obviously, it still gives you free access to the ForexAnalytix platform and chat room. So you can come and join us there. You can get an account between $25,000 and $1 million if you want to scale up your trading. Remember, your risk is just the assessment fee. If everything goes pop and you've got $1 million account and it all goes tits up on a black swan event, you won't be liable for any losses or anything like that. All you will lose is your assessment fee. So it's a low risk way to scale up. Right, let's get cracking. Just myself today, as Mr. K is off for the rest of the week. Over in China, there's been a PBOC economist paper research thing saying that China may issue additional special government bonds maybe towards the end of the year. So a research piece that's sort of hinting at what they may do. What the PBOC have done is they've given more details on one of their special programs to establish a special security fund swap facility thing of about 500 billion. That's going to, according to them, enhance internal stability of capital markets. In other forms, it's to give financial firms, hedge funds, a window to swap bonds and other collateral for money for buying stocks. So part of that. It's not running yet. They've just started accepting applications to join the swap scheme. So it hasn't kicked in yet. This isn't new news. It's just a update on some of the measures that they announced previously. A lot of the market is getting its hopes up ahead of this Ministry of Finance meeting in China, which is happening on Saturday. So that's going to present some potential weekend risk for risk trades. Obviously, if they drop some big news, then we're probably going to get a gap up in Chinese stocks. We might see risk trades, commodities, commodity FX moving up sharply on the open as well. On the flip side, if the market gets disappointed again, like it was on Tuesday, then the opposite may happen and we may see further disappointment in Chinese stocks and risk assets. So be careful. Early warning for any trades you may hold on Friday. Keep an eye on that meeting. Over in Japan, we had a bit of data out, some PPI data, which looked okay, 2.8% year on year, beating expectations 2.3%, up on a high revised 2.6%. Month on month was flat. It was expected to drop, so that was a plus on that side of things. So inflationary pressures still maintained over there, even though we saw one of the inflationary measures dipping back a few days ago or last week, I think it was. The BOJ have had a poll out. It still shows the majority of households are expecting price increases. 85.6% of those households expect prices to rise a year from now. That is down from 87.5% in the last poll. They expect inflation to rise by an average 10% a year from now. The median was 8%. Prior median was 8%. 83.6% of households expect rises in 5 years from now versus 82% in the prior survey. And over those 5 years, they expect inflation to rise by an average of 7.9% versus the median 5%. So some good news on the expectation front. Running high, those numbers, 85.6%. For expectations that prices will rise, and the Bank of Japan and the government will want those sort of numbers and expectations kept solid. because those expectations will drive price behavior and consumer behavior. If people think prices are going to rise, then they may bring forward spending. Why pay a higher price later when you can pay a cheaper price now? But it's still the expectation is needed to keep the ball rolling, because then that's going to bring those wage hikes and it becomes a bit of a snowball event. We had a fairly bullish sounding Deputy Governor Himino from the Bank of Japan saying Japan is entering a new era. The Japanese economy has started to move again, and monetary policy is also moving. We are witnessing record high corporate profits and record high wage increases in Japan. But he kept his feet on the floor and followed the hymn sheet from the rest of the BOJ, saying that they will adjust the degree of easing if their economic outlook is realised. So no hikes until then. What might cause a hike from the Bank of Japan is Netflix. They're going to be raising their monthly subscription in Japan. And that's what decades of low negative rates and buying more than half your bond market gets you. Good old Netflix, always looking for an opportunity, get those prices up. Over in Sweden, Riksbank Sweden says inflation has stabilised close to target. So potentially important comment there regarding future rate moves. If things are stabilising, that means they can potentially continue to bring down rates, but they just need to keep an eye that they don't bring rates down too fast, too far to stoke inflation, and then they'll have to go the other way. Over in Norway, we had some CPI data out as well, and a little bit sticky still over there. Core CPI 3.1% was expected to go up, so good news that it came down. Headline CPI was expected to rise to 3.2%, but came in at 3%, still a rise on last month. So there or thereabouts for Norway, and we know what the Norges Bank are doing there, keeping rates potentially on hold for a while. Over in Germany, we had a bit of a soggy one in the retails number there. Month-on-month sales down 1.4%. So not looking too good over there. Some of the other numbers as well. Well, those are May retail sales. Sorry, these are the June numbers, so a bit behind. Well, actually, what have we got here? June, July, and August. Oh, look at that. Don't know what they're doing with that one. So we have to take the latest ones there, which the ones I note anyway, 1.6%. So forget everything I just said, because we'll take the latest ones. 1.6% on those numbers there, year on year, up 1.9% versus minus 4.4%. And they must have been getting their numbers from the UK's ONS on that lot. ECB bods, Patsalidis says there seems to be room for a rate cut, not being overly committal on that. ECB's Maklouf warns of upsides risks to the inflation path. Says persistent services inflation and stronger than expected wage growth presents those upside risks. ECB's Wunsch says he's not too keen on rapid rate cuts, and he's undecided on what to do in October. NBA from yesterday, nothing really has been showing up in most of the numbers there, but I'm just keeping half an eye on the 30-year mortgage rate just to see how sentiment in the market is affecting those rates. So a bit of a jump, 6.36%. Obviously, that reflects the NFP data and the undovish tone that the Fed have been taking recently. So again, if you want just a little weekly indicator to keep an eye on sentiment for rates, this weekly MBA number is something you can keep an eye on. We did get some wholesale trade and inventory data. Inventories rose 0.1%, so that was okay. Sales, though, looking a tiny bit soft at minus 0.1%. Was expected to rise 0.4%, and that's down from 1.1% previously. Mexico, well, it's not on the calendar as usual. CPI out from Mexico. I can't be asked to go looking for it. Came in a little bit softer on the year-on-year numbers. CPI 4.58 from 4.99 previously. Core came in at 3.91 from 4% previously. As we've heard from one of the Banxico members, Heath, he's expecting rates to stay on hold for a while. Fed's Logan says she favours a more gradual path back to normal for rates, though she did back a September decision to cut rates. Fed's Daily said she's fully supported the 50 pip cut, and that the size of the September cut does not say anything about the pace or size of next cuts. 2 or 1 more cut this year is what is likely. We had the Fed minutes out, and I think the press have made or tried to make more of it than what's said, because all the headlines are that a substantial majority backed a 50 pip rate cut, and that some officials would have preferred a 25 pip cut, which, as I say, the press is trying to, sow some seeds of doubt over that 50 cut. The fact of the matter is, irrespective of the views, there was only one dissenter who didn't vote in favour of going a 50. So even those who would have preferred a 25 still voted for a 50. So it really makes no difference to anything. According to the minutes, nearly all officials saw higher risks to the labour market. They also agreed that the reduction of the balance sheet can continue for some time. Well, it said in the minutes, this report that all participants supported lowering the interest rates. That was true, of course, although we had Bowman, who only wanted to go at 25, the only dissenter. None of it really matters, because we've heard 100 times from each of them, and we know what we're getting for the rest of the year. Likely 2 more cuts of 50 basis points in total. So that'll be 2 25s or a hold and a 50. Who knows? That's the expectation that we were going to be messing around with into the next 2 meetings at least. We had the 10-year note sale, which was again a little bit on the soft side, 4 pip tail. There was a pickup in indirects, up to 77.6% from 76% previously, so that looked good. Directs was lower. The bid to cover came in at 2.48 from 2.64. So that was a little bit on the soft side. Again, it's a funny time. There's not much to take from these auctions right now. They look soft on paper, but it's not the market. It's not making too much fuss about that. RBC Securities talking about the Bank of Canada, see them cutting rates 50 pips in October. Everyone's joining the 50 club now for expectations and whatnot. Again, I don't see why the BOC need to go a 50. We do have the jobs report, their jobs report on Friday, so maybe that will offer some clues. But the BOC have been cutting steadily, so I don't know why they would want to jump to a 50 unless they're worried about something. But anyway, RBC think they're going to do a 50 this month. Oil news, and the Russian deputy PM said it's too early to assert if global markets are ready to digest additional OPEC plus oil production or increase in oil production in December. Changes to the OPEC plus deal are currently being discussed. They will later decide on the December 1st summit format. So there is talk about what they're going to do with production and quotas into the next meeting. But I don't think the market's ready to get increased production, typically seeing as demand isn't picking up yet. Political news, Trump has vowed to end double taxation on Americans abroad, according to the Wall Street Journal. So that's potentially good news for high net worth individuals and the like. Getting double tax, that's going to be cancelled. So that's always a good boon and a good vote winner. So we'll see what happens with that. Right, let's have a look at what's coming up. As I said, CPI, the big event, the only real event, really. We do have a load of more Fed wafflers banging on today. So we'll hear what those lot have to say for themselves. We've actually loads of them today. Oh, can't wait. Anyway, CPI is going to be the clincher here. Now, headline CPI is expected to come in 2 pips lower, 2.3% from 2.5. Core is expected unchanged at 3.2%. Now, as I've been repeating, you remember what the Fed want to do. They want to get rates down. Okay, so even if we get, a hotter number here, it's probably not going to change that. It will get the market moving and it will get the market adjusting rate expectations, but that doesn't mean the Fed are going to stop cutting rates. But we're not playing the 50s game anymore. We're playing the 25 unchanged pendulum game. So that's what we're going for here. Anything higher in the core will get those expectations moving to washing out one of those 2 additional cuts that's expected. So 3.3, 3.4, that'll be looking very hot. If CPI is at or above 2.5%, then again, we're going to see that washing out of at least 1 cut, and probably for the November meeting, meaning everyone will move their expectations to December. So get ready for the pendulum to swing. If it's a soft number, it probably has to be significantly softer to get the market, maybe shifting a bit more dovish towards the 50 mark. But probably need to see a 2 handle on core CPI and headline CPI 2% or under. If it's got a 1 handle on it, then that's a different kettle of fish. But if we're around expectations, unfortunately, I can't see much price moves on that, given where the market's sitting right now. So if we're coming in expectations, then I think the Fed continue on their path, no problem. 2 more cuts, 25 pips each. Okay, so that's the way to play this one. Obviously, there's going to be people looking at third decimal places and the components, shelter, owner occupied, or owner equivalent rents and that sort of thing. So even if these numbers come in unchanged or as expected, wait for some of those details to drop just to see if the sticky parts of inflation have moved back. Those things like shelter and whatnot have ticked up the last couple of months. They were coming down and the Fed heads were happy it was coming down, but they've been a bit stubborn in the last 1 or 2 reports. So more stubbornness there. Again, that will drive the expectations for rate cuts more so than the headline numbers. So keep an eye on those. They'll come out somewhere. Some propeller head will have it. We also get jobless claims, which have done nothing for years, a couple of years now. So, but just keep an eye in case there's a wobbly number thrown in for good measure. And that should keep you all well and good for that data. Obviously, if you're in our chat room and you've got any questions about the CPI data, then obviously put it in there, and I or anyone on the team or anyone else will be happy to answer that question for you. Right, let's have a look what's going on in markets. Start with euro dollar. It's creeping and creeping and creeping lower. I've said all week that I don't see any reason why we suddenly start seeing any big moves. We just running from one support point into another support point, all these sticky areas, traffic zones and the like, and it's just not leading to anything. There's still a risk here, obviously, with the CPI data, that we do get a sudden volatility injection and you get a big old move, and then you need to assess that, and then it probably see volatility dropping off again, and then we go back into snore mode. So if you're looking to get short, then you're going to be wanting to see a number that takes us maybe up to that 110 area, 109.90. And if we get up there and hold that, then that's somewhere for shorts to get in. On the other side, if you want to be short around here, you've got to be careful that we're, again, running into more traffic down into the low 109s. But on the other side, if you're looking to buy somewhere, then this is a potential area to have a look at, the 109 area down into 108.70, which is an old zone that's been on my chart forever and a day, all the way through going back 2017 and beyond. So it's a big old traffic zone, 108.30, 108.70. So that's the euro. Be careful messing around in the middle, as I say. I'm certainly not looking to take in any fresh trades ahead of CPI. If I was in something, that's a different get the fish. I have to manage it, but I'm not looking to get in anything fresh. Got a pretty clear book actually at the moment, apart from the Aussie Kiwi and Euro Sterling. That's all I've got on at the moment because I'm not really fancying anything right now. Dollar yen, that's another move up into the 149s, but now we've been dribbling lower. We're now below 149. A lot of people looking for this 150 area, and that's well within range if we get a hot CPI number. Conversely, we're still in an uptrend, so any dips are likely to be bought. So yeah, if we get a big number that maybe takes us down to 147s, 147.20s, then that's something I might have a look at. So like I say, around all big data points, plot your levels, plot where you would prefer to trade rather than try and mess around in the middle. And if you get your levels, then you assess it at the time, and if you decide you like it, you give it a go. And if you don't, then you leave it alone. Dollar CAD, that's continued to grind up. A bit annoyed at this one because I was pissing around at that 136.50. It got knocked out both ways, and then off it went. So not liking that one. We are into a bit of a resistance area, or a bit of former support and resistance area around this 137.30s area. Not a big level, but you can see just going back, we've had various moments where it's been support and resistance, so it's being respected at the moment. Obviously, we're very close to the CPI, so there's every scope to see another move or break up and further upside in this one, as it is to see a return to the downside. But again, remember the trend that we're in at the moment, so this could be one where dips are likely bought. A test of 136.50 that holds, that might look enticing for me. Just a quick update on my Aussie Kiwi. I've got an offer right up there, which hasn't been triggered yet, just below the 111 area. It's got up to 90, so I might have 89.90 I think we got up to. My offer's at 95, so I came a couple of pips before it's pulled back. I'm being pretty static with my levels. That's my level. That's where I want to get in at. I don't want to move it around for a few pips here or there. Still happy to stay on the short side for this one. And this one again, more a bit like Euro Sterling, moving on the different speeds between Aussie dollar and Kiwi dollar at the moment. The Kiwi, obviously the weaker one of the two. The Aussie, give or take a little look under, we're holding this area around the 67 figure. I've got quite a bit of tech down here, quite a bit of tech confluence down here. We got this 38.2 fib at 15. We got the 55 DMA coming in at 10. We've got the 67 level, and then we've got the 100 DMA coming in just under that at 90. So a bit of a zone of tech in here. And as you can see, it's also a bit of a traffic area. We've got some other levels, 66.80. So it's pretty thick down here in terms of tech levels. Could this mark a bottom? Again, going to have to wait for that CPI to decide, I think. If it's a hot CPI number, we're probably going to break under. But just see where we are later on in the afternoon. If we've had a spike below, but we're back above 67, or at least the 100 DMA here, then maybe we're going to see a bit of a bounce. But so far, bounces have been pretty weak. So it tells you the mood that's going on in this pair at the moment. We're not bouncing too far off this level down here right now. Ali, let's have a look what you're up to, mate. You're still holding your shorts. Nice one. Good, good. Cable, you're long on cable. Where are you long on cable? 131.78. I don't know. 131.78 or 130.78? 130.78. Yeah, I thought so. Not sure what to say about this one. My levels were pretty clear yesterday. 130.50 or 130 even are the levels. But, not that I want to be long the pound for any reason right now, but if I was going to go anywhere, probably 130 is where I'd look to buy it. So yeah, again, I don't know. You look a bit in the middle of the range, mate. You're bang in the middle there of this range that we've seen all week. So not a place I'd like to be sitting, if truth be told. But your levels are your own, mate. So I wish you luck with that trade. Let's have a look at gold before the reg tells me off for not having a look at gold. It's doing what it should be doing in terms of the tech. This was the low area that I was looking for to cement this range. We broke it. We're holding below it. 22s, 23s, 24s, whatever you want to call it. It's close enough. You know, this is tech perfection. When you find a level that's support, then you break it and it resists. Okay, this gives you your opportunities. Okay, you could have tried a long in there. You may have got stopped, but you didn't need to give it a lot. You didn't need to risk a lot. Okay, and then you can look at where the next levels are. Support's coming in at the 38.2 fib of this phase of the rally, the September leg, let's call it that, into the 26 figure, which a lot of people got their eyes on. So bit of a decision to make here. Okay, we either break back above, or if not, the more likely it is we're going to break back below, because this at the moment is a tight intraday weekly range at the moment, very tight. So something's going to happen eventually with this one. Whether it's we break back up and go back in, or whether we break back down is another matter. Of course, we could wash this line out a bit and maybe we extend the range here up to there, and then the range just opens up a bit. But for now, it's playing nicely with the levels. So that's what you want when you're building up a price picture. You want to see what levels become important, and this one is becoming important. So that's the one you can then use to trade off, and then we just see how important this one down here becomes. Okay, so you got your market set. You know what it's doing. You shouldn't be caught out too badly. Okay, there's no need to be, you know, losing 10, 15 bucks on trading any of these levels. Okay, if they go in, nice tight trade. Antonio, let's have a look at oil. Okay, I'm going to look at UK oil because, as I've like to tell people, this is the one that's more geographically apt to what's going on in the Middle East. Okay, so I'll keep an eye on UK oil. It's more the leader than the follower at the moment. Oh, excuse me, someone's spam calling me. Let's mug them off. We're seeing that it's all over the shop at the moment. Oil, we've obviously got this sort of risk premium in at the moment, this Israel stuff in at the moment, but we've got quite a significant dip off tomorrow over the last day or so. I think maybe there's a little bit of China disappointment in that move as well, and then we obviously had some headlines that maybe some sides were looking to some sort of ceasefire and whatnot, and wherefore. On that front, I didn't mention this news either. Excuse me. Where we are at the moment is that Israel's still prepping to retaliate and undertake some major military action against Iran. So we're still in that mode at the moment. But there were stories yesterday saying that their response is likely just to focus on military targets, not oil and nuclear and other infrastructure like that, which takes a bit of the sting out of it, but that could change. On this ceasefire business that's been spoken about, a US official apparently was told, or the CIA was told by a Mossad chief, that any ceasefire in Lebanon must include a Gaza deal. So if it's not a wholesale deal, they're not interested in it. So as we stand now, there's still the likelihood that Israel responds, and then we see how Iran responds to the response. Both sides are still saying that they don't want to do anything that escalates things into a war. So it's a bit of a strange situation. They're happy to lob stuff at each other, but they don't want to take it too far. But escalation is escalation. So anyway, any big headlines that Israel has launched some sort of big strike on Iran is obviously going to make with risk assets moving, and oil is going to jump. There is a vote going to be happening today. I don't know if it's happened, but the Israeli cabinet were going to vote on to whether they're going to respond to Iran. So I think that's going to be the first driver of any risk trades, and we'll probably see oil moving back higher again. Levels wise, we're just banging between various levels at the moment. You can't really rely on the tech when you've got all these, geopolitical headlines, because a big headline and that doesn't care for bombs and rockets, don't care for coloured lines on the chart. So really, if you're going to be looking at the tech, look at some of the bigger areas. Obviously into this 81, 82 handle, it could be a big level. Down below, it's just becoming a bit wishy-washy down here. I will look at US oil because I know a lot of you guys and girls trade it. So again, this is one of my traffic zones down here, 72, 73s. And when things are all nice and normal-ish, then we see action around it. But right now, we're just up and down and up and down and up and down. So go with the flow on this one, guys and girls. Antonio, if you're doing something in it, let us know what you're doing. Gives me a better idea of what to look about. Derez, your bias is still long. Okie dokie. You'll need that 2600 level to hold in that sense then. Just going back to China, and I put some bits and bobs in our chat room just reflecting this. We've seen stocks had an up day in China again, but it's not looking overly bullish. We're not looking like we're going to be marching up to those highs anytime soon. A bit more consolidation on this one. We heard that, or Goldman Sachs put out a piece saying that hedge funds had actually on Tuesday sold a record amount of stocks, Chinese equities, and actually some of them turned short. So the euphoric opium bubble seems to have already burst there. The market is still waiting and waiting for more stimulus measures. It's probably getting too excited about stimulus measures. The PBOC China, this isn't them just starting. They've been doing fiscal measures and programs and propping up certain sectors for years, particularly property market, as we all know. They've been doing that for over 2 years now. So this isn't this stimulus isn't new stuff. It's ongoing stuff. But as always, the market wants more and more and more. And it's not giving it, it spits its dummy out. So, but this is, as I said, as this is a risk from the weekend and this Ministry of Finance meeting that we got. Copper, that's always another good one to look at in terms of what's going on in China and risk sentiment. It's stabilised after some of the moves this week, but as you can see, we're not looking like we're heading back towards those highs. So the opium trade is washing out a bit. This could be another big mover if we do get a big headline, stimulus headline over the weekend. Could see a move back up, 445s, 450s, something like that. Yields, they're continuing to climb, so still looking bearish on price, bullish on yields. Got a bit of a level up here at 412. Now, as I always say, you don't do tech on yield, you do tech on price. So these are more just areas where obviously the price ran into trouble. So 412 is a level here. Hot CPI number, we're going to see yields rally. Okay, and we're going to see the dollar respond as well. So that means dollar yen particularly. If we're above here, it's really getting too hot for my liking. That's the market running too far to the undovish, to the hawkish side of things. So I'm going to be looking at that for when, at least when the dollar might start running into trouble. If yields run into trouble up there, it's going to become too enticing. Yields 420s, something like that. 10s, pretty much the same picture. Again, got a bit of a level here. 408, 409. Ignore those moving averages. I usually take them off. So yeah, it's just a bit of a place where yields are running into trouble up here. Okay, so again, above there, the magic 420 mark, that's going to be a big old level if we're up there. But, you know, we look at the size of this move that we've had recently. So going to 420 wouldn't be that too far out the question on that. Guppy. Who wants to look at Guppy? Where is it? I can't find it. Oh, there it is down there. No, I've lost it. Oh, who is it? There we go. Not much to say about this one, mate. We are holding this 100 DMA. So that's about the closest I can give you. It is a bit of a level in here if you take it off of there. Let's stick one in just so you know. Boom, stick it in there. So it's a bit of level all on its own. So that's your top side level there. Spreads and whatnot. What's that? 195, 80s, 196, call it. So you know where your resistance is. What are you looking at this one, Derej? Are you looking at more from the pound aspect or technical aspect, or a bit of both between what's going on in the UK and what's going on in the yen? Gavin, you got a range 190, 196. Yeah, I can see that. Let's just visualize that. 190-ish. Stick it in there. There you go. That'll do. Yeah, I see the cut your jib on that one, mate. 190. So pretty decent range for this one. But this is looking, the way it's following this 100 DMA, that's looking pretty good. But, you know, we're not far off it, given we've got this CPI data. So, you know, but UK budget, if you want to trade the UK budget, I would go with something other than pound yen, purely because of the volatility we got in yen at the moment. Okay, I don't see many people trading this one on the back of the UK budget. Obviously, if we're holding this level, if we continue to hold this level through all the CPI and everything going on elsewhere, then maybe you've got a bit of a trade if you want to catch a bit of a move on any weak news. But as I've said with the UK budget, you've got to be careful trading this one. I don't think it's going to be positive for the quid, but perhaps not in a way that you know is going to get you 300 points or something like that. This isn't going to be a Liz Truss moment. Okay, so if that's what you're expecting, I think you might need to dial down your expectations, or at least be aware of that if you're trading the quid. And you know, if there's no big moves, know what you're going to do if those don't come along. You're probably better playing it in something like euro sterling, not even cable really, because cable's got the dollar influence as well. I certainly wouldn't trade it now ahead of the budget. Maybe a week, 10 days before the budget. That's if you want to start getting positioned and seeing where markets are, then maybe that's what you think about trading. But I certainly wouldn't look at the pound now when we've got you know, 2.5, 3 weeks to go before the budget, because lots can happen before then. Lots of price changes can happen before then. I'll go on to euro sterling quickly. While I'm doing that, if you've got any other things you want me to look at, put it in the chat there. I'll have a look. Otherwise, I'll look at this one and then maybe we shall call it a day. It's back on the slide. We've had this move up to the 84s. It's now heading back down. Let's open it up here. Probably 85, 83s, 50s down into here is where you're going to be looking. If it's going to find a bit of support, then that's where it will need to do so against this level here, just to maintain this step up in range from this one. I'm still long a bit from 83.20s, so I would like it to get above 84.20. But again, I don't see any big reason why this is going to bust a big move either way. It will move today if there's a big CPI number, purely on the back of what's moving faster, euro, dollar, or cable. So if it's hot news, cable probably goes a bit more than euro, dollar. Okay, in which case we're going to be seeing that maybe ticking back up towards 84s. Okay, so cable will likely move more than euro, dollar. So keep an eye on which direction that goes. Anything else? Last orders. Otherwise, we shall call it a day for today. Have a look. I think we've covered a pretty good swathe of things. That's it. Thank you very much, boys and girls. Have a great day. Watch that CPI day. Take care. Don't get stuck in any silly trades in the middle of any prices when you know you got this CPI data coming up. Wait for that. See what happens. React after. Have a great day, everybody. See you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.